Hey guys, TC here. Hey, I've been in trucking for quite some time, and I've dabbled in getting a truck. Once was with a lease uh, for the company I worked with. It was a brand new truck, and another time, just before COVID hit, I got a used truck with like 600,000 miles on it, thinking I can go into it with a shoestring budget because I listen to certain people thinking like, hey, they know what the hell they're talking about, and then, you know, the rest is history. And from my own experience, it comes down to a numbers game for really any facet of business. Um, it's all about your actuaries. These are your bean counters that go in there and do risk assessments and optimize your business model, especially when you have assets. In our case, trucks. So, just doing a little AI delve here. I'm going to read this to you for the benefit of those who are driving and listening to this, but probably should hear this and realize that there may be exceptions to a rule as far as old equipment on the road. The bean counters aren't wrong. And the bean counters run trucking anywhere from insurance to actually the selling of the vehicles themselves. So they have the full macro view of the statistical data as opposed to the one person's empirical view of what they're doing with their business. So I just thought you guys need to hear this. I would not personally suggest you go out and start a jank fleet held together by bubble gum and baling wire and thinking that you're going to be able to, I'm going to make $1 million if I can get this $15,000 truck to last 3 years. Because statistically speaking, it's not going to happen. Not saying it won't ever happen. It's just that the likelihood is not, right? There's like a statistical chance that you walk outside, you could get hit by lightning. Is it possible? Yes. Is it likely? No. But there's still videos of people out there getting hit by lightning. You understand what I'm saying? But that's not the majority. Anyway, here we go. While the actuarial field does not specifically provide advice on selling semi-trucks, its core principles of financial analysis, risk assessment, and long-term valuation can be used to determine the optimal time to sell. This requires calculating the sweet spot where maintenance costs begin to outweigh the truck's productivity and remaining resale value. By applying these principles, you can determine if it's better to keep your truck running or invest in a newer model that is more reliable, efficient, and technologically advanced. The optimal time to sell. The best time to sell is not a set date, but a window determined by a combination of financial and operational factors. During the sweet spot, many owner-operators find the best time to sell is before the manufacturer's warranty expires. This period offers a balance between low mileage, factory warranty protection, and high resale value. Avoid the 500,000 mile mark. Beyond 300,000 miles, resale value can depreciate rapidly, and the potential for expensive repairs increases significantly as the truck approaches 500,000 miles. Before maintenance costs spike. As a semi-truck ages, it has a predictable spikes in repair costs. A major cost spike is known to occur around the 7th year of service. Selling before this predictable maintenance cost hit can help preserve your profit. And that's important to realize, guys. Even if you got your 1.5, 2 million mile truck, it's on its 4th rebuild, whatever. That's not every component on that truck. That frame is still a 2 million mile frame. Just because you rebuilt your motor, have you rebuilt every component on that truck? That's also 2 million miles. Is that a 2 million mile differential? How about the transmission? How many times you had to replace the clutch? How many times can you keep doing the front end? Radiator? I mean, every component on that truck is still an old truck. And you need to realize that. And what the bean counters are saying is that, hey, right around the 500,000 mile mark is when a lot of this stuff is going to start coming to fruition. It's predictable. It's not an if, but it's a when factor. And that's what the actuarials are all about, right? It's assessing risk. So realize that. Because that transmission is going to grenade. That motor will need to be rebuilt or replaced, if it can be. If you have something like a PACCAR engine, you can't really rebuild those. From my discussing with owner operators, they're just not meant to be rebuilt. You just have to get another crate engine, and those are expensive, but they're predictable factors in purchasing an older truck. And that's why that's why the megas will go out and get the new trucks and dump them on the market when it has like a year remaining in the factory warranty to keep the resale value high. But they know in about, I don't know, 150, 200,000 miles down the road, it's going to start nickel and diming you with a potential catastrophic maintenance event happening. And whether you have the capital to cover it or not, that's an individual basis, right? Do you have the credit? Do you have the money available? Can you borrow? Or do you just have it socked away somewhere in cash? So these are all very important factors in considering purchasing an old jalopy. Key actuarial considerations: a crossover point, maintenance versus depreciation. Actuarially, the decision to sell comes down to a crossover point. The moment when the high cost of maintenance and repairs, a variable cost, begins to exceed the cost of the truck's depreciation, a fixed cost, a decision to keep or sell can be determined by comparing the two opposing forces. With depreciation, the market value of a truck decreases steadily over time. New trucks depreciate the fastest in their first few years, while used trucks tend to have a more stable rate. Maintenance: as a truck ages, maintenance and repair costs increase. These costs include both scheduled and unscheduled repairs. And see, that's important too, guys. With the new equipment, you had the factory warranty. You don't have to pay as much in maintenance other than just the regular PMs and so on. But you have a higher payment. When you buy an older truck, your payment's less, but you're taking on more risk for the maintenance because you don't necessarily have the factory warranties. So the money that you save in the payment, you're shunting off into maintenance. You're paying about the same, is what I'm saying. You're not saving money by getting a used truck because you need to save thousands of dollars and sock it away unless you just want to pay, an interest rate. I'm borrowing that money for that inevitable repair, and it's going to happen. It's going to, and from my experience, I never had an issue, a major issue with my new truck that I was leasing as opposed to the one that I got on a shoestring. And one thing they just never discuss is the downtime of the shop. You could be in that shop for something relatively simple, but the mechanic can't get to it for a week. You cannot recoup that downtime. So a newer truck limits the downtime because, statistically speaking, it's going to break down less than an older truck. Again, individual experiences will vary, but the macro view, the new stuff is going to last longer than the old stuff as far as breaking down. That's just hard data. Okay. Anywho, total cost of ownership is the TCO. A semi truck is a business tool, not a personal asset. To make a sound financial decision and analyze the total cost of ownership with the actuarial style financial modeling. This includes fixed costs, loan payments, insurance, licensing, and other fixed expenses. Operational costs, fuel, maintenance, and repairs, which are variable and often increase over time. Makes sense, right? Opportunity costs, the capital tied up in an older vehicle could be used for a newer, more efficient one. And that's important to remember too. Say you're a carrier, I can go out and spend $40,000 in this truck and I'm going to pay it off in cash. But what if you were to, cut that in half, and now you're putting 20 grand down on two new trucks. So now you have two new trucks. Yeah, you got payments on it, but Now you got 2 trucks, and you can put a driver in the other one. See, this is how the carriers think as opposed to an individual driver. They don't tie up, and they also use OPM, other people's money, and they will utilize the bank's credit to purchase these assets, and they'll make their payments on, and they'll get rid of them when they can get some value, to maximize the value. So they're not doing this with their own money. They're doing it with the banks. They're playing with house money, in other words. They get to the point they're playing with house money. These CEOs aren't out there stroking checks for these trucks. They're calling their bank up, and then they buy in bulk and get discounts and so on and so forth. There's a lot of advantages to that, but they're not tying up. They're not mortgaging their house to go pay for these trucks. Signs that you need to sell. Beyond the core financial analysis, there are clear performance indicators that signal it's time to sell. Increasing maintenance costs. Right? Frequent or expensive repairs are a strong indicator that the truck is no longer a cost-effective asset. Again, not only just the cost of the repair, but all the downtime that you're losing that you will never be able to make up. You can't get that back. And it's significant. You really need a budget for that. I've experienced it myself. You know, your emergency is not a factor in the alacrity of that technician that has a waiting list for people that also have emergencies that need to get their rides looked at. You just go in line, you go in the queue, and you wait your turn, and then they get around to it when they get around to it. And there's not much you can do about it unless you have a mobile shop or you know a guy. All right? The rest of us, you're taking that number and you're waiting for your number to be called. Declining fuel efficiency. As engines age, fuel economy decreases. When fuel costs rise significantly, it may be time to sell. Yeah, and that's true too. The engines nowadays are much more fuel efficient than they were 15, 20 years ago. The norm now is about 7 miles a gallon or greater. Back then, we're talking about 4.5 to 5 miles a gallon, which, you know, when you're looking at it as an outsider, it doesn't seem a whole lot, but you're figuring all miles. I mean, it's huge. That's huge. You're burning a lot of money up at the stacks to operate that old equipment. End of the warranty. For fleet owners, trading trucks before the factory warranty expires is a common strategy to avoid paying for expensive repairs. Right. Lack of modern technology. Older trucks may lack modern safety, navigation, and fuel efficiency features, making them less competitive or attractive to buyers. Some people like the Bendix, some don't. I know it's personally helped me. I remember going through on I-10 through Louisiana, going across the Ashfaya Swamp or Bayou, however the frogs pronounce it. And it was thick as pea soup out there, and I wasn't even going that fast. But the Bendix system slowed down my rig before I could see that car that was stalled on the highway because traffic came to a halt on I-10. So yeah, that's just an example from my personal experience where that has helped me. Anywho, anticipation of new regulations. New emission standards can render older trucks non-compliant. Selling beforehand avoids. That's mostly if you're like in the California area because they're full of commies. But the problem is California is the most populous state, so they, for some reason, get to dictate to the rest of the union. So where California sneezes, the rest of the union catches a cold. So I know some of you guys can get away with having your deleted trucks elsewhere, but it's a big ask never being able to go into California again as a truck driver. Even though I despise going there myself, I occasionally find myself out there. Anyway. Truck no longer meets needs. Business growth or a change in hauling needs may require an upgrade to a more powerful, specialized truck. Right. So for my example, yeah, I can go out there and get a condo truck, but that's really more for dry van, whereas I only need a single bunk mid-roof because I do tanker. So the condo truck, because it has more mass to it, it's heavier, and I can haul less product. And some of the customers I go to, they have a requirement on what you need to load and go deliver to their customers. So, yeah, that's a difference that I can give you an example upon it in my own personal experience, right? So that's why you see different products with different cab styles, as an example. And then you got like the heavy haul, so you need like the third axle, and so on and so forth. But anyway, I just thought I'd drop this because there's people out there promoting jalopy, fleets where you're holding the whole thing together with baling wire and chewing gum. And yeah, maybe if you're lucky and your stars aligned and you got a couple $100,000 in the bank, you can get away with it. But that's not most people's experience. It just isn't, especially in trucking. So the safest, least risk-averse situation would obviously be get newer equipment. It does, however, mean you need to have better credit, or you get on with a company that offers newer trucks on a lease purchase. Not all lease purchases are equal. Some are better than others. I know there's legislation coming down the pipeline, and they're discussing it at the FMCSA and DOT. So times be a-changing. But the point is, the newer the ride, the less downtime you're going to have, and that's what ultimately is a determining factor. I mean, it seems pretty obvious, but it is what it is. We're still discussing these merits all of these years later, right? And the numbers don't lie. The bean counters are highly educated on the matter. They've been studying the data across the full spectrum of trucking for decades now. So one asshole with the jalopy fleet is not going to be the be-all, end-all of the trucking business model, and that's the way you absolutely have to do it to make it, right? So, and it's not, you're not even taking into consideration the shippers and consignees. The shippers, in a lot of regards, don't want trucks older than 10 years old hauling their freight anyway, because they don't want to have to repower that load because your truck broke down halfway to wherever you're taking it, because that just becomes a pain in the ass. So a lot of brokers are even putting the restrictions on there of no more than 10 years old. And I've seen that cropping up across the industry for other trucking companies as well. You want to bring your truck on to haul, XYZ freight, or a trucking company, they want to make sure that your truck is, 10 years old or newer, because they know that the breakdowns are coming. It's not an if, but a when. And it's a predictable issue you can deal with up front, or at least mitigate it to a certain level just by having newer equipment. And let's not also beat around the bush. I mean, having the newer equipment is nice too because of all the write-offs, right? The truck payments, the depreciation, depends how you have your setup, right? That lease purchase truck, every one of those payments, fuel, insurance, they're all write-offs. The higher the fuel, it's write-offs. You're not saving that money. And it will help you remain in a lower tax bracket when it comes tax time, even though you'll be making about the same. There's less to write off with an old truck as far as, payment and depreciation and so on and so forth. So you need to take all of these things into consideration. And that's what I got to say about it. You guys take care. TC out.